Hopefully you are ready to get going here. My name is John McNertney. I am from Green Ocean Global Advisors. Yeah, that was a little bit of fun, wasn't it? But what you just heard there was an example of the next thing that's going to be knocking on our doors. Artificial intelligence is coming, folks. That was written by an AI robot that one of my friends here in Lisbon showed me yesterday. And it's a whole song about our investment firm that I did not want to subject you to. Not the whole thing, anyways. See me later if you want to check out some of these songs. Uh, Welcome. It is 6 o'clock here in Lisboa, and it is 10 a.m. Pacific Standard Time. So we're getting started. Please let me know if you can hear me. Heyo. Hello in the chat. Hopefully you are. Is this thing on? All right. So just some housekeeping. Yes, the chat is working. Thank you for raising your hands, Mr. Van Pelt. I appreciate that. So the chat's working, I think, and the Q&A always works, just in case the chat is not working. So please, please, please put as many questions in there as you can while we talk, because we are going to get this show on the road. So today we're going to be talking about the HART Act and the U.S. exit tax. Hello there, Ryan. Ryan Aarons is my trusty co-pilot for this particular webinar. He is also the Chief Investment Officer here at Green Ocean Global, which reminds me that we should get started off with the slide deck here. So just to get started, our disclosures, the information that we're about to provide here, it is in fact not legally binding until you legally bind us, which is to say that we are going to be working with individuals that have a contract with us. So I see a couple folks in the room that are clients of ours. Grateful for your patronage, madams and sirs. But for everybody else here, this is just information. We're not going to be your advisor or your lawyer without some kind of formal agreement in place. So if you haven't met us before, I'm John. Here's a picture of me in San Francisco last month by a payphone. I thought it was funny that we had payphones in the beauty platform still. But I started this firm 3 years ago, and I have been doing this most of my grown-up life. I worked for Merrill Lynch. I've worked for TD Ameritrade, as well as a few other independent shops in the Bay Area. I have now way too much experience, about 16 years. Back in the old days, I wanted to be a psychotherapist for just a minute, but I guess I don't have enough empathy. I wouldn't pass the Voight-Kampff test. And I have a certified financial planning designation, and I'm a GFP fellow. And I'm currently located in San Francisco and Lisbon, Portugal. Today, it's Lisbon, Portugal, where I live for most of the time. Now, Ryan's going to be joining us in just a second here, but his credentials are almost as impressive as mine, except he lives in California still. He has been doing this job almost as long as I have also. He studied economics, and he has a degree in cryptocurrency. Did he put that on there? He did. Good. I always like to tout that because I am not a cryptocurrency expert, but this guy is, and that is why I am glad that he is helping us provide our clients with bespoke investment strategies, which do sometimes include a Bitcoin or two. And he lives in the Bay Area with his partner, Nicole, and he is a super cool guy. So what are we going to be talking about today? Today we're going to be talking about the HART Act. What is it? And we're going to be talking about the cost of leaving the United States of America for good. I have had more than a few of you guys that are in my chat room ask me whether that's a good idea. And whether or not something is a good idea, as you know, I like to subject to a little thing called math. So there are some taxes that must be paid. Indeed, if you decide you want to turn over your passport, and it's a problem. But how big of a problem? We will find. So we're going to talk about what constitutes expatriation, how could it affect your heirs, how's it calculated, and then Ryan is going to do some palate cleansing at the end. He's going to talk about what our investments are doing right now and what they might be doing in the year ahead. So let's get started. So introduction. Let's take an exit, or in Portugal, they call it the desvio. We're going to take a reroute, and we're going to do it via something called the HART Act. Now, if you look this up, you'll find that most of the HART Act will bring you back to 2008, or maybe even further back to 2003, when Operation Desert Shield and Operation Desert Storm took us into Iran, and then into Afghanistan, which made us all so much more complicated as the years behind that showed. And by 2008, President George Bush Jr. at that time ushered in an act to help provide relief to U.S. military service members. So there were a number of tax breaks that weren't being made available to soldiers, and so we rectified that via the HART Act. But it also ushered in a number of provisions that applied to folks that were expatriating. So the thinking was is if you're going to be giving up your green card or your citizenship status, then maybe there should be some special tax rules that apply to you. This is especially interesting because there was a gentleman by the name of Mark Zuckerberg, whose partner was leaving his company at that time, totally voluntarily, and was also on the hook for lots of taxes in the new company Facebook at that time. And so this was all happening at that time. This is sort of the political environment that gave birth to these new rules. So what were the provisions here? Well, most of what we're going to talk about can be boiled down to, are you a covered expat? If you are a covered expat, then all the rules we're about to talk about in a minute are going to be the rules that apply to you. What kinds of tax, we won't call them penalties, but it's going to feel punitive, will apply. It's only going to apply if you're a covered expat. So under the IRC section 87.7 and 87.7A, you are affected by the HART Act if you are a U.S. citizen or if you're a long-term U.S. permanent resident, if you have a green card. And so you're also going to have been flipped over from just a temporary green card to a long-term green card, which means that you've been in the U.S. with a green card for 8 years, 8 of the previous 15 years. So if you are that kind of person, then you probably know it. And furthermore, you're going to be a covered expat if you meet the income test or the asset test or the tax compliance test. Now, when I think of the income tax test, which is that you have over the last 5 years had a net tax liability exceeding about $190,000, I always think like, well, what kind of money do I need to make? And so that's why I calculated it out here. Basically, you're going to meet the income test if you've been making $500,000 a year for 5 years. Okay, so again, you're going to know who you are if you're this person, and you're going to have a sense that you probably should seek some assistance. The asset test is actually easier to meet. The asset test is that your global net worth exceeds $2 million. Okay, and so in San Francisco, that means that we own a home outright. Because in San Francisco, the average 3-bedroom home is now apparently, I think it's I'm going to get this wrong, but it's above $1 million. So it's pretty easy in the Bay Area if you're just making pay to exceed that $2 million global net worth test. And the tax compliance test is that you are leaving the country, and you are leaving the country in a bit of a hurry, or you're leaving a mess, or both. So if you are leaving the country and giving up your passport and you have not been filing your taxes, then you're going to automatically attract this attention. So we have put together a little flow chart for you, very simple flow chart that just says, are you a long-term resident of the U.S.? If yes, did you just relinquish citizenship? If yes, have you met the test? If yes, you're a covered expat. Not a super complex test. So good. So we know that we are going to be subject to these taxes if we are covered expat and we are giving up our citizenship. So what happens to us then? Well, there's going to be an income tax on exit, and that income tax is going to be based on your assets, and it's also going to affect your beneficiaries as well. So how do we expatriate? we should first cover what it looks like to expatriate. And what it looks like is you're essentially formally relinquishing your citizenship. So in order to do that, if you're in the US or outside of the US, you have got to go to the consulate and you have got to actually turn over your passport. And you also have to file a tax form that's called I-407. So you can do that either in the United States or you could do that abroad, anywhere where there is a US embassy. Um, and this also applies to green card holders. So you can turn over your green card to a member of the US State Department as well. It's an important point to make because I've been asked before whether I am going to be giving up my green card if I just do not renew my green card, and the answer is no. To abandon permanent residency, you must go through this formal process. And that's intended to be a protection to you as well. It's very hard to lose US citizenship involuntarily. The only case where you would not be aware that you're giving it, well, you'd probably be aware of it, is under situations where there is significant sedition or acts of terrorism being practiced against the US government. So think Boris and Natasha. I don't know why. I guess it makes me old. This is what I always think of when I think of when I think of terrorists. Yeah, that definitely ages me. I didn't think about that. But right. So if you're a green card holder, it is not the same form that must be filled out. You must return a form 8833. And that will also effectuate your formal expatriation as well. Oh, I'm sorry. Form 8833. This is temporary. Okay. So what is interesting is that if you're a green card holder and you are returning to your country of origin, you can file this form and you can exempt yourself from having to file the US tax return for up to 7 years. For up to 7 years. So for up to 7 years, you have to demonstrate that you have substantial ties elsewhere, and you will cease to become subject to that pesky U.S. tax return each year. But in order to do that, there must be a treaty tiebreaker in place. And even if you do that and you're not forced to fill out your U.S. tax returns, you're going to have to fill out the FBAR and your FATCA reports. So if you're listening and you think, oh, great, I can just fill out this form and not have to worry about filing US taxes for a period of time, that's true, but don't forget that you're still subject to FBAR and FATCA. There are some serious penalties if you do not. Again, what I'm including in here is just a reminder that you have to have this form on file for up to 7 years. But if you try to file this an 8th time, then that will be considered an act of expatriation. So beware. For individuals classified as covered expats, yeah, we just said that. So what is the exit tax? How are we going to calculate it? So if you have qualified as a covered expat, then you are rightly probably pretty nervous about this. And there are 5 different asset classes that are going to be subject to an immediate taxation upon expatriation. So the 5 asset classes are tax-deferred accounts, deferred compensation, ineligible deferred comp, beneficial interest in non-grantor trusts, and mark-to-market assets. That means everything else. And so, the net worth calculation, if you haven't gone through this exercise with me, is pretty easy. It's assets minus liabilities. Poof, there's your net worth. And so there is the broken piggy bank. So you've decided to expatriate. Man, well, you're going to have to actually take all of your IRAs, your Roth IRAs, HSAs, Coverdell's, and 529s and medical savings accounts. Those are for all intents and purposes fully distributed the day before you expatriate. So be ready for that. It's a deemed distribution, and so you're going to be subject to income tax on all of the savings that you have accumulated in those tax-deferred accounts. There's no gain exclusion limit on special tax-deferred accounts. However, the tax basis is adjusted to prevent double taxation in the future. So you're saying, aha, John, this is a deemed distribution, so I should take the money out of those accounts totally. No, I'm not saying that. What I'm saying is if you have money in those accounts, you're going to have to mark the asset value at the time of the deemed distribution, because you can keep the money in those accounts forever after. There might be benefits to do that, but you want to keep that watermark, because if you had $800,000 and you've paid income taxes on it, then when you take distributions later, you're going to want to not double tax yourself, not be subject to double tax on those assets. So for example, Marie, a long-term permanent resident with a global net worth exceeding 2 million, formally surrenders her green card, and as part of the exit tax, she has a $250,000 IRA, and it's treated as fully distributed on the day before expatriation. And so she has a deemed distribution of $250,000, extraordinary income included in her tax returns. The IRA is not distributed, but the tax basis is stepped up to reflect the portion that's already been taxed. So she has a $250,000 basis that she can look at when she takes distributions later on. She files her 1040 NR to report that distribution and pays her taxes then. Number two, so we have deferred compensation plans. So the IRA, the Roth IRA, those are deferred tax deferred accounts. SEPs, simple IRAs, and the 401k plan has a different rule that applies. To qualify as an eligible deferred compensation plan, the following must be conditions must be met. There's a payer requirement. So there must be a U.S. person or a foreign pension that is paying into that account. So you think about, like, the 401k is oftentimes there's an employer match that's associated with the account. That's what makes this account different, right? So these are not just your contributions oftentimes that live in these types of accounts. You have your employer or another person making contributions. The covered expat must provide the payer with a Form W-8CE, Notice of Expatriation and Waiver of Treaty Benefits. And for eligible plans, you are subject to a flat 30% tax. Okay, so you think about that. If you're already starting to think about these things with the planner brain, you're thinking, huh, it's interesting. That's different than the IRA is. But I could do a rollover if I wanted to, couldn't I? And that would affect the mix of assets that will be subject to these rules at the time of expatriation. So that's interesting. So all of these are going to be withheld by the payer. So whoever is running the 401k plan is going to be required to withhold 30% immediately when they learn about this from you. Ineligible deferred comp. So if you have things like, well, I really see a lot of RSUs in the work that I do daily, restricted stock units, stock settled appreciation rights, SARs, or foreign pension accounts, vested stock options. A lot of people have stock options. Deferred compensation plans are classified as ineligible if they do not meet the requirements for the eligible deferred comp plans that we've already looked at. And those are going to be treated as if they were sold at present value. Okay, so that's concerning also, because if you were granted a number of restricted stock units, I didn't put an example there, but I've worked with people from Ernst & Young, for example. They're issued RSUs as part of their compensation program. Well, they have already paid taxes on the RSUs when they vest, and now the RSUs continue to gain in value. They earned their RSUs and were taxed at $5, and they're worth $10 now. Well, that additional $5 in gain is all going to now be imputed as ordinary, or not ordinary, as capital gain on the day before you expatriate. So again, that's another piece of your 1040 that's going to need to be filed. You sold those RSUs, but not really. You still own them, but you were going to be taxed as if you sold them all the day before you expatriate. I did do an example. So we have Jim. He's 42. He's a single Portuguese-American dual citizen, and he's been making $800,000 for the last 5 years. So he's a covered expat. He plans to return to Portugal, and he wants to relinquish his U.S. citizenship. And he's also been in Australia. He's got a superannuation account that's valued at 400,000 Aussie dollars. It's $300,000 in US dollars. The account was accumulated prior to his becoming a U.S. citizen and has been taxed as an employee benefit trust. So the contributions were taxed, but growth is not taxed. So, we see he's been making lots of money. That tells us that he's definitely a covered expat. We don't have to know his net worth. Whether this account is classified as ineligible, his superannuation account, depends on the status of the payer, whether they're a U.S. person or not, and whether he submits the W-8CE within 30 days of his expatriation. So we haven't talked about this, but you do have to file this document within 30 days of your expatriation. And if Jim acquired that superannuation fund before he became a U.S. Taxpayer, then he might not have to pay. But we know that if he doesn't file that W-8CE, that he's going to have to pay on the superannuation account too. It's a lot of money that he's going to have to fork over. Non-grantor trusts, I am going to skip for today because I don't run into a lot of these. And everything else, I think, is of course, of interest to all the rest of us. So under the HART Act, covered expats, they're required to calculate and pay cap gains on all assets that are classified as mark-to-market assets. So think about like a piece of property, for example. If you purchased a house in San Francisco, 10 years ago, you think it's gone up in value? Yeah, you bet it has. These are taxes if they were sold at fair market value on the day prior to expatriation. An inflation-adjusted exclusion limit applies to the deemed gains in these. Hold on. So if you have done this in 2025, the exclusion amount is $890,000. So all gains exceeding this exclusion are subject to the U.S. capital gains tax. Gains or losses from deemed sales are included in the covered expat's taxable income for the year of expatriation. Interesting. The tax rate applied to the capital gains depends on the character of the asset and its holding period. Assets held for more than 1 year are typically taxed at long-term capital gains. Less than 1 year, you have short-term capital gains. That makes sense, right? I mean, we know what short-term capital gains are. That crypto that we bought in January and we sold in February, short-term cap gains. A house is actually a long-term capital gain usually. So for example, speaking of San Francisco property, Jane, 55, U.S. green card holder and an Australian resident. She's lived in Australia for the past 5 years and has a global net worth exceeding $2 million. She's a long-term resident under the HART Act, and she files the I-407 to expatriate. Including in her global balance sheet is an investment property located in San Francisco. She purchased the property in 2005 for $800,000, and it's worth $3 million today. Sounds pretty familiar, actually. Because this property was not her primary residence for 2 of the past 5 years, the gain doesn't qualify for the primary residence exclusion. Aha, that would have been nice. So that's a really good point of how, at the point of expatriation, every rule that would have technically applied for the sale is going to apply. So sale of this $3 million home for $800,000, if Jane's a single gal, she can exclude $250,000. If she's married, she and her husband can exclude $500,000 from recognition as capital gain. But because it wasn't her residence, she doesn't qualify for that. So she's got a total taxable gain of $3 million minus her basis, $800,000. She's got a $2.2 million gain. Yuck. Now, if this was her only asset, she can apply the exclusion. The exclusion limit in 2023, it wasn't 890, it was 821. And so she's got a $1.37 million long-term capital gain, not great. She's going to be taxed probably at 20%, would be my guess. 15 or 20%. So her AGI is going to be affecting that. In addition, there's a special transfer tax that's applied to any U.S. recipients of a gift or bequest received prior to expatriation. Aha. So don't think that you can give your money away right before expatriation as well. There's going to be a 30% flat tax if you're caught giving gifts to a non-U.S. resident just ahead of expatriation. But there are other strategies. So there's three main strategies that I'm going to cover, and then we'll basically be into Q&A and Ryan and done. So strategy number one, take your capital gains exemption and step up your basis. Makes sense. So covered expats can exclude that $890,000. So that's of course the first piece that you're going to want to knock out. So you take all of your capital gains and you take that 890 and net it out. Simple. So managing the timing of gains and losses can of course help maximize this exclusion. As I've pointed out, there's the primary residence exclusion. So if you're selling a property, make sure that you've lived in that property within 2 of the 5 last years. To qualify, the taxpayer must meet the ownership test, and then tax loss harvesting. I have talked about this ad nauseum, and most of us don't care because it's kind of wonky, but you can keep the basis in your portfolio sort of from getting too high. So, we do direct indexing at Green Ocean, for example. We're always trying to kind of lop off some of the capital gains every year so that you don't end up with lots of capital gain. What that does ultimately have a value is if you don't let your capital gains get very large in your investment accounts, then you won't have events like this. This might not be the only event that you encounter in your life where you go, oh my God, I've got Apple and I bought it in 1999. So by minding your capital gains, you can avoid having a one-time event like expatriation, where you have to capitalize on all of your capital gains right away. Individuals may progressively realize capital gains on assets over a number of years. That's what I just said. So just kind of mow the lawn. Keep your capital gains from getting over long. Number two, progressive gifting to a non-expatriating spouse. Aha. So that's interesting. So if you're married and on good terms, you can effectively collaborate on things like this. There's a strategy here where you can gift up to $190,000 annually to a non-U.S. spouse, and that doesn't use up your lifetime unified credit. Okay, so you don't get the unlimited marital gifting. So unlimited marital gifting is in the U.S. You can give things to your spouse. The IRS doesn't care at all. What this says is if you have a non-U.S. citizen spouse, you can actually gift that person money and it doesn't trigger any taxable event as long as it doesn't exceed 190. Gifts above 190,000 are permitted, but they will reduce the donor's spouse's lifetime unified credit. So you have a $13.99 million credit. And so this actually points out that this is probably one of the biggest loopholes. Did I put an example? I didn't put an example. So the example would be, you're a U.S. citizen. I have a wife. Maybe she's Swedish, and we don't share all of our assets. I have an account with $5 million, and it's listed just in my name. Well, if I know I'm expatriating even next year, I could give all the money to her. And I would just have to file a gift tax return that shows that I'm doing that. That would eat in my lifetime exclusion. But right there, that would get the asset out of my estate and into her hands, and it would not be subject to the exit tax. If you wanted to be really clean about this and clinical, you could actually do 190 a year, and that wouldn't eat into your lifetime exemption. But that's an issue which would affect those of us that have more than $14 million to start with, which it's a good problem to have. First world problems, as they say. There's the way that we do it. Oh, there was an example in this one. Okay. Yeah. Well, that's basically, yeah, that's what I just said. Strategy number 3, gifting to an irrevocable trust. This strategy is the strategy for the kind of AAA players in the room. So we've already exceeded the sort of the $14 million benchmark. We don't have a friendly spouse. It's not a citizen that we could take advantage of. This is a really tough one. This is where you have a long-term permanent resident or a U.S. citizen that's planning to expatriate. They create a special third-party expatriation trust. This trust has to be at least a 6-year trust. Yeah, you have to do this at least 6 years before the event to get your assets to below that $2 million threshold, and it has to be not owned by you at all, and it has to be structured to allow limited drawing rights on the property. So you basically have to hire an attorney that is going to become the guardian of the trust and will not allow you to take ownership of the trust until a specific event occurs in the future. And sometimes the ultimate beneficiaries can be your children. I've only heard of this actually working just a couple of times. And so if you're the person that requires the James Bond trust, you're probably going to know this, but it could be useful if you own, part of Facebook, for example. Strategy 4, roll ineligible deferred comp items into specified tax deferred accounts. We talked about this one basically. If you're going to be taking a 401k and you don't want to be subject to the 30% withholding tax, just take that 401k, pop that into an IRA, maybe even a Roth IRA, if you have a couple of years to do some planning. And that, I think, is a pretty self-evident strategy. So if you're just sort of wanting a recap, covered expats. Covered expatriates are U.S. citizens or long-term permanent residents that meet the income test, which is, they make about $500,000 a year for 5 years. The asset test, they have a global net worth in excess of $2 million, or they're trying to get out of Dodge and they have not been filing their tax returns. And the exit tax is going to apply to 5 categories, and those 5 categories are easily going to capture all of your assets. Most of us have assets in IRAs, 401ks, or they have market assets. If you're a beneficiary of a irrevocable trust, or you know someone that's in that situation, you can do a little bit more research. You can come to me as well. So I hope that you don't hate that I blow through material, but that's basically it. I'm going to pause here for questions, and then I am going to pass the microphone to my Chief Investment Officer, who's just going to talk a little bit about current events. We have a lot going on in the world, so I always like to make sure we have ample time to discuss these things. This is one of the ones I'm sure we will not have any questions. Oh, here's the Q&A. Okay. Okay. So the Q&A is the only place where you can ask questions and receive answers, apparently. The chat was shut down. Can you hold US and Portuguese passports simultaneously? Was a question from somebody. And Ryan, thank you for answering that. Okay, we have an open question. Do we need to cash out our stock portfolios as well, was a question. I mean, I probably should have just said that right off the top because I'm sure that's on everyone's mind. Cashing out your stock portfolios, no. As long as you're not a covered expat, your stock portfolio isn't going to matter at all. So if you don't have more than $2 million, then don't worry about it. And if you do have more than 2 million, then we just have to consider whether you're going to be a long-term holder of US securities. And if yes, then you probably still hold on to those stocks, because if you look around you, the S&P, it's still just booked 24% back-to-back gains in the last few years. It's still a great market to invest in. We're just going to have to calculate the size of the tax hit. Anonymous attendee asks us, what if you are below the benchmarks for covered expat? Well, to be crass, the US IRS probably doesn't care about you, which is great. I want to evade notice. So yeah, so if you're below the benchmarks, then you can safely expatriate. Although there is one additional problem, and that is future streams of income, which might be coming from the United States of America. So let's talk about your Social Security. So if you're below the benchmarks for being a covered expat, you would think not a big deal to expatriate. But when you're taking your Social Security payments later on, and your investments are producing income, there is going to be a mandatory withholding that's applied against all those sources of income. So, for example, you have $30,000 in Social Security payments coming to you. You may be garnished 30% right off the top of all of the payments that you take, unless you take umbrage in a tax treaty. So you can claim the treaty position, for example, in Portugal, and you can reduce that to a 15%. Okay, so the U.S. maintains tax treaties with just about every country in the world. There's a list on the IRS website, and 15% is the going rate. Some countries like Bulgaria have negotiated 10%. Some countries have a 20%, like China. So every country has a different rate, but that's the one thing you do have to worry about. Question comes from another attendee. If I have a substantial Roth, it's already tax paid, so I just lose the benefit of it continuing to not be taxed. If I need to distribute it before expatriating, assuming I'm 59 and a half or older, the only capital gains will come from the real estate and the traditional /SEP IRAs and 401ks. Correct? You are indeed correct, sir or madam. I'm sorry, it says you're anonymous. Yeah, so that's one of the strategies that I have actually had a lot of fun with over the last year is preemptive Roth conversions. So as the attendee pointed out, Roths have already been taxed, okay? And so the only thing that would trigger an additional tax on a Roth account would be if it helped you to exceed that $2 million mark. It would add to the amount of assets that would effectuate the triggering event. So if you had $2 million in a Roth, that would still trigger the look on all of your U.S. assets and trigger the covered expat status. Another attendee asks, if one is benefited by using the NHR, the non-habitual residency status in Portugal, how does expatriating affect that NHR status? That is a question that gets into tax residency. In the sense that your tax residency status in one country in no way affects your tax residency in another country. So the NHR doesn't care. The Portuguese IRS would be happier. They are happier when they don't have to care about what's going on in the United States of America. Okay, and so the NHR is in no way affected by your expatriating. I mean, you may be interested in pursuing this strategy because you're interested in having a zero tax basis across the world. I mean, that makes sense. Like I've met a lot of Europeans who are happy to be European and not have to deal with the US and their citizenship-based taxation because they can claim the NHR status and live in Portugal and not have to worry about any taxes at all, except for various streams of income, which NHR is dealing with. Another anonymous attendee asks, what is the tax on Social Security withheld if you are then a UK resident and then you expatriate, or does the country you are residing in tax it? That is correct. The country that you are residing in is generally has the primary tax benefit. So if you're living in Portugal, for sure, the Portuguese tax authorities are going to have the first bite of the apple. Okay, and then the other country is going to then come up after and tax you as well, and then there's the tax, and then the tax treaty will apply to deal with any overlap. Okay, so in other words, if you're a U.S. tax resident and a Portuguese tax resident, then you benefit from that tax treaty to eliminate the double taxation. That's what that's there for. Got another question about Social Security payments. I maybe didn't answer that question well before. The question is, does expatriating affect your Social Security payments? For sure. If you file as a non-resident alien, let's just get this out of the way. Leaving the US, any time that once you've become effectively not a US citizen, you're just like everyone else in the world. that's receiving income payments from something happening in the US. And anyone else in the world is going to automatically be subject to withholding. So when Social Security is paid to you, the Social Security Administration is going to withhold 30% off the top, unless you tell them that there's a tax treaty with the country that you're currently residing in and you are a tax resident of. So if you're in Portugal and you're not a US citizen, you can get your Social Security payments because you paid into that pension, but you're going to be taxed 30% or 15, assuming that you tell them that you're claiming the treaty position. And that's going to apply broadly across every type of investment activity that you perform. I have some business that I do with some Europeans who want me to invest for them in the United States. They're Portuguese. They're not American persons. Schwab actually is responsible for and do dock all of their dividends, income, capital gains right off the top by 15% because we help them to take the treaty position. So hopefully that helps. All right. Well, I'm going to pass the microphone, and then if you have more Q&A, more than happy to hear it. I am going to go ahead and hand it off to my co-host here. Ryan is unmuted.
Hello, hello.
Oops, sorry, I muted you. All right,
No worries. All right, thank you very much for the handoff, John. And yeah, if you wouldn't mind sharing the screen again, and we can take a look at some slides together. I will make this relatively quick, but I know the market is on a lot of people's minds. You know, if you're watching U.S. politics, pretty big day yesterday, and I'd like to talk about what we have kind of lying ahead. We've got most of 11 or more than 11 months ahead of us, and I think it's a good opportunity to look back and look forward. So there we go. Sorry, just give me one sec here. Great. All right. Well, all right. So I wanted to start with the quilt chart for 2024. Now that everything's in the books, we can take a look at what was in favor and out of favor. As you can see, the vertical slice here, that's 2024. Almost everything in the green. Bitcoin sitting at the top. We'll look at the winners and losers on the next screen. But I actually like this because it gives us some context. This now goes back 20 years to 1994. And if you kind of take a step back, you can see that it is difficult to predict you know, what's going to be green every single year, right? If we look at these different, there we go. If we look at these different categories, you know, there are some bad years in tech stocks, and we just had a pretty nasty one in 2022. On the grand scheme, it was a good year last year. That is 2 in a row now after a pretty brutal 2022 where we had a lot of red. And uniquely, which I wanted to draw some attention to, it was one of those very rare occurrences in 2022 when treasuries and bonds were also down at the same time as the broad markets. That's not been the case this year. We had a pretty strong climb in Bitcoin especially. The NASDAQ, which also contains your big tech companies and the AI craze kind of stocks, up 30%. Gold, surprisingly, up 27%. S&P 500, 25%. Interestingly enough, a 60-40 portfolio made up of 60% stock market, 40% bond market, was up 15%. The two actually still worked pretty well. We had some volatility in the summer. We will be taking a look at the chart over the last year as well. As far as the losers go, we had only one category in the negatives: long-term treasuries, corporate bonds, inflation-protected securities, commodities, and Europe. Europe, or developed international investments, were kind of the bottom performers. As luck would have it, we can pretty easily dismiss, or we know why these three were on the bottom of the pile. And just going back to the quilt chart really quick, that's because the Fed dropped rates by 1%. So when the Fed is in a rate reducing mode, we do experience some challenges if you're buying treasuries. But for those of you who already owned bonds, you actually probably had a pretty good year. So there we are. On the note of rates, this is where we stand with the federal interest rate. Right now, the federal funds rate is 4.5 actual, 4.3 effective. Why is that different? Because unless you're a large government or financial institution, you can't get 4.5. The rest of us get 4.3. With that said, we have this now in context over 22 years back, and I just like to include this because the highest that we've seen in the last couple of decades was reattained, and now we're falling back off. Couple of things to consider. The Fed having an interest rate at all gives them the ability to reduce volatility and kind of help our investments as well. The Fed can only do two things: talk about changing rates and change rates. We are expecting further interest rate reduction. Let's not forget that their target is 2% inflation. 2024 number right now not adjusted, looking like it was about 2.9. So still holding to that expectation of a further 0.5% decrease total. We shall see. Keep in mind, if the market goes gangbusters and we have inflation going back up to 6-8%, they kind of have to raise rates. If we hit a recession, well, they've got a lot of meat on the bone to stimulate the economy by dropping rates. Something we're watching closely throughout the course of 25. This is interesting. I think, when we have a shift in analyst consensus or sentiment, it's worth noting. The blue line here represents overall just polling a bunch of strategists, Goldman Sachs, JP Morgan, all of them. Where is their sentiment average, right? And that's the blue line. The purple line is the S&P 500. You can see coming out of 2022, analysts were a little bit behind the market for much of the run-up that we've experienced, and now they've jumped ahead. A lot of expectations around policies and maybe tax cuts, things like that. I do want to note the title here because when we look at the last time sentiments were all aligned across the board ahead of the market, it was pretty much right at the peak of the 2022 downturn. So hopefully this is not going to be something that holds, but this is actually not, and not to be overly contrarian, something that is kind of a red flag. Looking at another potential red flag is we are in the first year of a new administration. A lot of things can be said about that, but really to the point, when we look at all presidential terms, the first year almost always includes some early growth scares. When people come in and they sign a bunch of executive orders and change a bunch of cabinet members, invite controversy, we can see a little bit of a growth pause. But again, I think the overall sentiment is pretty positive, at least as far as money goes. An interesting just bit of data for us to think about is that the outgoing administration did do a lot of deficit spending. There might have been some political strategery, to borrow from George W., going on there, but it is interesting to note that we have never entered a recession with GDP, or with deficit this deeply into the negative. What this suggests is deep pockets from the government, maybe very bailout happy. There's a lot of money out in the world that is not necessarily invested that could be, and therefore it is kind of hard to start a recession in that kind of environment. Not impossible, but a pretty strong data point in favor of no recession imminent. This is, I think, an interesting note. I'm pulling in the station here, almost done. 56% of the years, the S&P either peaks in January or December, right? So that's interesting, right? A lot of these middle months get sort of lost in between. The percentages here represent when the market peaked in months. So 40% of the time it's in December, 16% of the time it's January. Looking at what that could mean going forward, here's a bunch of analysis going back. I believe this is about 100 years, most of the modern market. When we have stock performance, when we look at stock performance following a negative Q1, it's much more anemic at 2.6% versus a positive Q1. So setting a good, strong early Q1 path here is going to be important for what we see into the future. The crystal ball still needs some additional information. We got to see how much of campaign promises and regulatory changes might actually take effect. In the meantime, I did want to spend a moment on this chart, not to be too crazy Charlie drawing red lines on a wall, but I don't want to forget that this 1,000-point run we've had has been over 9 months before any elections were decided. So, we really are running on the back of some pretty strong growth. And I just drew that big pink line there to kind of give us an average. The blue line on the screen is a moving average. And what I like about looking at this is it kind of draws attention to this over here. The S&P 500 really seems to be flirting with that 6,000 number. And, as far as what the future holds, I do think that we are expecting further US excellence, or let's say outperformance versus the rest of the world. So many of these companies that are really going gangbusters exist in the United States and are not as focused on some of the offices in the EU or elsewhere. And I think we've been kind of waiting, holding our breath to see what'll happen next. So, Goldman Sachs research quote down here, but I don't want to miss the forest for the trees. When we had the election, which would have been right in here, that trend line was a little too steep for us as analysts to feel like that was sustainable. If we go back to sort of our regular run here, you can see the direction we were going. Right, so expecting the unexpected while hoping for the best. Looking back in history a little bit further, this goes back to 1980. So we've got Reagan back here and a bunch of others in between. I think that this is really fascinating because you can just draw a consistent trend line that hits these, where you have crashes that lead to stronger lines, right? So this is where we start talking about converging and opening. Moral of the story, I expect more booms and busts. This is not our grandfather's economy where it's just steady up and to the right, 6% average. This tends to be a boom bust economy post-tech era, right? This growth curve was a little steep and it went back to the long-term trend. I believe that the long-term trend with our modern way of kind of doing things where governments step in and bail big businesses out, it still remains to be seen what the future holds. But, the modern economy is basically all here on this one chart. And it does suggest that, we've got some potential for continued growth while keeping an eye on keeping money safe when that opportunity dries up.
As long as we don't draw it all off into Bitcoin, right?
Indeed.
Sorry, we always like to talk about that here. I'm dating myself again, not just with Boris and Natasha, but I look at Bitcoins and I'm like, what does it actually do? Like,
Right.
can I get a burrito with a Bitcoin? I don't know.
And I mean, on that note, it's kind of interesting when it's called cryptocurrency. Definition of a good currency is one that's stable. As it is, crypto appears to be a good investment, which doesn't necessarily make it a good currency. But I digress. That's maybe for a more dedicated webinar.
Totally. All right. Well, thank you, Ryan. Everybody that hasn't had a chance to ask questions, if you have additional questions, happy to talk about either. I mean, I know that these were two totally disparate topics, but it's what we think about every day. We do financial planning with a global emphasis, and we do all of this other work in investments. So I thought it was relevant to bring them in. So I don't see any open questions right now. We have a couple of minutes left. If you don't ask any questions, I'll start playing our AI authored music again. Okay, here we go. Yeah, I scared him back. Somebody said, good idea to have a seminar focusing on crypto. Richard, I just saw you break your silence. You sent me an email 10 minutes ago and you have questions on crypto. Big heart
Let's
from
talk.
us. Yeah. Ryan, you up for it? You gonna do one on crypto next?
I'd love to. I think as it stands, it's a good opportunity to kind of refresh what is it at its base. What is blockchain, right? This is also where NFTs exist, and how real is it? I think it also begs this really great question that I will leave as for people to think about. What is a dollar? As you think about crypto, what is a US dollar? And I think that that's a good conversation starting point. We would love to do a seminar in crypto and expect one from us soon.
So, anonymous attendee, thanks. And if you went back to the U.S. or kept your U.S. citizenship, your Social Security would just be taxed in the U.S. at your specific tax rate and not the 15% withheld. So, it's 50%. So, the anonymous attendee, I think I've been chatting with this person. The 15%, just to be really clear, is going to be the withholding rate that is applied if you're in Portugal or any other country that has a tax treaty with the US and you're not a US citizen. Being a US citizen, especially for Social Security, is hugely beneficial because remember, if you're a US citizen receiving Social Security payments, and again, you're a US citizen, most of your Social Security isn't taxed. Okay, so unless your income is over certain thresholds, you're not really being taxed on most of your Social Security. And indeed, the maximum amount of Social Security income that can be taxed is 85% of your income. So I don't want to get into it with everybody around that topic. And then we did have a question about compensation, yeah, we're actually mostly AUM model at our firm, and we will keep doing this for free because actually we are huge academics, but we are trying to avoid your growth gets strangled if anyways the whole compensation conversation. You go to Reddit and have it. We can't have it here. We're trying our best to do everything we can. Any other questions before we go? Otherwise, this has been a really lively group. Thank you guys for the conversation.
Thank you.
I'm not gonna turn the music back on, Ryan.
Yeah, please do. Thanks, everybody. Great to chat with you all.
All right. Thanks,
All right.
everybody. Have a great afternoon. Bye-bye.